Let's have an honest conversation about funding for startups and entrepreneurs in Australia. In 2006, Australia's oldest medical research group, the Walter+Eliza Institute, found their breakthrough innovation. They identified the amino acids that make gluten toxic to some people. Therefore, they could create the first vaccine to immunise against celiac disease and a global market of anywhere between 30 to 40 million people. They created a small company to raise capital. So you would think that investors in Australia would get behind this company and inject the capital they needed for clinical trials and research because of the massive opportunity. Wrong. The Australian venture capital industry is small, but significantly much more risk averse than other countries like the United States. Australian culture also does not accept failure well, and people are ostracised for it. So the company moved to Boston, raised $20 million immediately, and the vaccine will now hit the market after 2020. I've run startups and been involved in others. This story rings very true to me. However, slowly in Australia, things are changing and more channels of funding are opening up. Ever heard of the term friends, fools and family? It's often where entrepreneurs must start first to raise funding. You also need to be able to pay your living costs, so holding a day job while being an entrepreneur at night is common. Therefore, it is a source of funding. Be aware though that any of your friends, fools and family relationships may not react well to your startup if it fails. Next, there are angel investors. They are willing to put in their own money for equity or as a business loan. But angels is not a completely accurate description. There is a reason the TV show The Shark Tank is called what it is. Yes, they are a beacon of light when banks, friends, fools or family or others will not lend. But they don't give away their cash lightly. They will want a level of control over your company, your strategy, your product. Venture capital firms are likely your next port of call, but you would need to have an established revenue by now and believable growth forecasts. The level of control increases again. The venture capital company is investing from a pool of funds that their investors put into. Only 25% of companies they invest in are expected to make a positive return, and less than 10% to return a much higher yield than average. So they are ruthless in their approach to working with startups and will quickly take control of a startup they believe is failing to deliver. They will then act like an administrator and look to sell it off or liquidate to minimise their losses. Banks are often forgotten by startups because they don't believe they will get the money. However, if you can meet the bank's requirements, they provide a stable source of debt funding. They also do not meddle in your company unless you can no longer meet the interest payments. For larger companies, there are also the equity markets. These provide longer-term funding channels where you provide equity to a large range of investors. Of course, you now don't have just a few contacts in one venture capital firm to satisfy. You could have thousands of investors with potential voting rights to keep happy. Along with banks, there are also a number of other debt financing options. Trade credit, where you buy goods or services on credit from a company that extends credit terms to you. This is always useful, but can become problematic if you don't pay on time, because it is often assigned to everyone that you have no cash. Accounts receivable factoring, you sell your accounts receivable to a third party so that you receive your money quickly and they chase your debtors for you. But generally, the cut they take is substantial, and so this debt channel can be one of last resort. Mutual savings banks and savings and loan associates are also options, but are very unlikely to be used by startups. Time to recap. Let's take a summary look at the pros and cons of the main types of finance a startup can access. Equity financing can provide a lot of capital, no interest payments, no obligation to repay capital. If you don't have discipline, however, you can burn through it and deliver very little. You have to give up equity, and you also give up a level of control, and your provider wants a higher return on investment. Debt financing. You don't give up control of your company. You can borrow only what you need at the time you need it. You can use it to leverage and increase profitability. You have to meet your monthly interest payments. You can be affected by changes in your interest rate that is out of your control. You will likely need to provide assets for security or collateral, which means potentially risking an important asset like your own home. So both types of funding have pros and cons. You shouldn't rely on just one channel, but use multiple funding channels to spread your risks.